Hello, and welcome to the lesson on patterns. Patterns are a combination of candlesticks in a chart. Depending on the market situation, you can interpret patterns in various ways. You can look at a chart and interpret a pattern as bullish or bearish. It is just like interpreting any other situation or event. For example, when you see dark clouds and lightning in the sky, you immediately think a storm is coming. That is precisely why they named the top reversal pattern as dark cloud cover. The names of patterns are quite intuitive, so you will easily remember them. In this lesson, we shall talk about multiple candle patterns, namely, a bullish piercing pattern and how it is recognized, a dark cloud cover pattern, and how it is different from bullish piercing pattern. The other important topic includes the engulfing patterns, which includes both bullish and bearish. Finally, we will discuss how the tug-of-war between bulls and bears can lead to quick changes in a trend. Buckle up because we have a lot to discuss. A bullish piercing pattern is a two-candlestick pattern that is also called a bottom reversal pattern. It can help traders identify potential buying opportunities in the market. Here is how a bullish piercing pattern is recognized. Look for a downtrend. The first step in identifying a bullish piercing pattern is to look for a downtrend in the price of an asset or a security. This means that the price has been consistently declining over a period. Finding a downtrend is an essential first step. Look for a long red candlestick. The next step is to look for a long red candlestick that represents the downward movement of the price. This candlestick should have a long body and a small or non-existent wick at the bottom. Now you might ask how long a long candlestick is. Well, that is relative. You look at the other candles and behavior of the security over a period and decide the length based on the previous candles. Look for a long green candlestick. The third step is to look for a long green candlestick that opens below the low of the previous candlestick and closes above the midpoint of the first candlestick. This second candlestick should have a long body and a small or non-existent wick at the top. Confirm the pattern. Once you have identified the two candlesticks that form the bullish piercing pattern, it is important to confirm the pattern by looking at other indicators which will be discussed in another training. Consider entry and exit points. If the bullish piercing pattern is confirmed, it can be a signal to enter a long position. Traders should set stop-loss orders below the low of the first candlestick to limit potential losses. Exit points can be set at a predetermined profit target or when the price begins to show signs of reversal. In sum, a bullish piercing pattern is a two-candlestick pattern that can help traders identify potential buying opportunities in a downtrend. By recognizing this pattern, traders can make informed decisions on when to enter and exit positions in the market. The opposite of bullish piercing pattern is dark cloud cover. Dark cloud cover is a top reversal pattern. In this pattern, the first session is strong white or green real body. The second session opens above the prior session's high or its close. The second session should ideally be closed below the medium of the first session. If the second session does not close below the middle of second session, consider waiting for a third bearish session below the middle of the first. Let me give you a tip. If you would like to create a shorting setup, which basically means a sell position, you should find a security with a steep uptrend that is overbought and gets to a resistance, meaning that the price does not go up from a certain range. This bid you see is the considered resistance. In such a scenario, if dark cloud cover is formed, it would be a great short opportunity. Obviously, you should not trade on the short pattern alone. Other indicators are of value when taking a position. Make sure you watch the videos of the Training on Technical Analysis course where indicators are discussed in detail with combination of charting strategies. Patterns must be used in combination with other indicators. The fourth topic of this video is engulfing patterns. As the name suggests, in engulfing patterns, one candle covers the other. They can be both bullish and bearish. Bullish and bearish engulfing patterns are two of the most common candlestick patterns used in technical analysis. They are formed when a small candlestick is followed by a larger candlestick that completely engulfs the previous one. The direction of the trend determines whether it is a bullish or bearish engulfing pattern. A bullish engulfing pattern occurs when a small red candlestick is followed by a larger green candlestick. The green candlestick engulfs the entire range of the previous red candlestick. This pattern indicates that buyers have taken control of the market, and a reversal in trend from bearish to bullish is likely. A bearish engulfing pattern occurs when a small green candlestick is followed by a larger red candlestick. The red candlestick engulfs the entire range of the previous green candlestick. This pattern indicates that sellers have taken control of the market, and a reversal in trend from bullish to bearish is likely. How to recognize bullish and bearish engulfing patterns. To recognize bullish and bearish engulfing patterns, follow these steps. Step 1. Identify the current trend. Is it a bullish or bearish trend? Step 2. Look for a small candlestick followed by a larger candlestick. Step 3. Determine whether the larger candlestick completely engulfs the previous one. Step 4. If the larger candlestick is green and engulfs the previous red candlestick, it's a bullish engulfing pattern. If the larger candlestick is red and engulfs the previous green candlestick, it's a bearish engulfing pattern. Now let's get to the important part, which is using bullish and bearish engulfing patterns in your trading strategy. Bullish and bearish engulfing patterns can be used in various ways in your trading strategy. Here are some examples. 1. Bullish and bearish engulfing patterns can signal a reversal in the trend. Traders can use this information to enter or exit positions accordingly. 2. Traders can place stop-loss orders below the low of the bullish engulfing pattern or above the high of the bearish engulfing pattern to limit potential losses. 3. Traders can use other technical indicators to confirm the bullish or bearish engulfing pattern before entering a position. Bullish and bearish engulfing patterns are powerful candlestick patterns that can help traders identify potential reversals in the market. By understanding how to recognize and use these patterns, traders can make better decisions and improve their trading. After listening to these videos, now you know that trading is the tug of war between bulls and bears, which can lead to quick changes in trend in the financial market. As you all know by now, the financial markets are driven by the forces of supply and demand, and these forces are represented by two groups of investors, the bulls and the bears. The bulls are investors who are optimistic about the future of a particular security or the financial market as a whole. They believe that prices will rise and are willing to buy shares at higher prices in the hope of selling them later for a profit. The bears, on the other hand, are pessimistic about the future and believe that prices will fall. They are more likely to sell their shares and may even short a security in the hope of profiting from falling prices. When these two groups of investors are in a tug of war, it can lead to quick changes in trend. For example, if the bulls are winning and there are more buyers than sellers, the price will rise. However, if the bears gain the upper hand and there are more sellers than buyers, the price will fall. The tug of war between the bulls and bears can also be influenced by external factors such as news events or economic indicators. For example, if there is positive news about a company, the bulls may become even more bullish and buy more shares, driving up the price. Conversely, if there is negative news, the bears may become even more bearish and sell off their shares, driving down the price. In conclusion, the tug of war between bulls and bears is a constant battle in the financial markets, and it can lead to quick changes in trend. As traders and investors, it's important to keep a close eye on these forces and understand the factors that can influence them. By doing so, we can make more informed decisions and potentially profit from these quick changes in trend. In the next video, we will continue with patterns. Next lesson is about Harami pattern. Thank you for watching and see you in the next video.